Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Bank of Japan has been the most dovish major central bank during 2022. At a time when other central banks like the US Fed, the European Central Bank and the Bank of England were racing to raise rates, Bank of Japan kept its rather dovish tone alive even as the inflation there touched a 40-year high. Of course, the level of inflation in Japan is nowhere close to where it is in other major developed economies. As a result of this dovish policy in a hawkish environment, the Japanese yen lost significant value so far this year. This was the macro backdrop of Japan until last week. However, something changed after the Bank of Japan's monetary policy meeting on December 19th and 20th. Last week, the Bank of Japan decided to maintain yield curve control, which aims a short-term rate target of minus 0.1% and long-term rate target of 0%. Also, Bank of Japan kept the risk asset purchase program unchanged as widely expected. The central bank also maintained forward guidance and kept it closely tied to the developments of COVID-19. However, the major change which took markets by surprise was the central bank's decision to widen the tolerable band for 10-year yield to plus or minus 0.5% from plus or minus 0.25%. This was a surprise to markets because previously Bank of Japan repeatedly made a case for keeping the band at plus or minus 25 basis points. Even the minority who expected this policy shift were only looking at spring 2023 for this to happen. Accordingly, in a sharp knee-jerk reaction to this announcement, Japanese government bonds sold off sharply, the Japanese yen strengthened remarkably, and Japanese equities were down considerably. In the press conference that followed the policy statement, Governor Kuroda categorically denied that this move accounts to a policy tightening and offered a more technical rationale. As such, the bond market functioning has worsened significantly, and given that the Japanese government bond yields serve as the basis for interest rates on corporate bonds, loans, and similar instruments, the Bank of Japan is concerned that corporate bond issuance could be negatively impacted if this situation were to persist. Therefore, the bank believed that enhancing the positive effects of the monetary policy by widening the tolerable band will contribute to policy sustainability. Despite this explanation, markets started to wonder if this can be considered as a hawkish policy pivot by the Japanese central bank. At this point, we believe that the recent policy action was indeed a technical adjustment, but do see the long road ahead for the Bank of Japan policy to turn more hawkish in the months to come. Indeed, Bank of Japan will likely make a hawkish pivot when its other developed market peers are widely expected to make a dovish turn. Crucially, we believe that any policy shift in Japanese monetary policy will likely be gradual and long drawn. Yet, such hawkish tilt might prove to be appropriate for the Japanese economy, where the economic growth is likely to hold up well next year. For the context, International Monetary Fund (IMF) expects the Japanese economy to grow 1.6% in 2023. Whilst this might not sound like a stellar growth, on IMF estimates, it is the highest growth rate across G7 economies and compares very positively against Germany and Italy, where the domestic economies are expected to contract next year. In terms of market implications, we do expect the yield differentials between the 10-year US Treasuries and 10-year Japanese government bonds to tighten. This development will likely help the Japanese yen to strengthen against the US dollar. On Japanese equities, we retain our overweight. Looking at history, we notice that Japanese equities tend to perform strongly during the initial phases of both strength and weakness of Japanese yen. Especially during the episodes of the yen strength starting from a weak base, FX returns add to equity returns in local currency terms. We believe that Japan and other parts of Asia offer diversification opportunities given where they are in the post-COVID economic cycle. Unlike in the West, the recession probabilities are incredibly low in the East. However, though not our base case, in case a global recession does materialize, most equity segments are likely to post losses. Even then, given the relatively low valuations, Japanese and Chinese equities could still outperform in the relative sense. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.